the Great Depression. When you hear those words, you probably think of one thing: the stock market crash of 1929, Black Tuesday, panic on Wall Street. But what if I told you that was just the opening act, the spectacular explosion that everyone saw, while the real disaster had been building silently for years, deep within the foundations of the global economy? The Great Depression wasn't an accident. It was an inevitability. And the story of how it happened is more than just a history lesson. It's a warning that echoes in our financial world today. Let's rewind to the Roaring Twenties. On the surface, America was booming. Jazz clubs, flapper dresses, and a stock market that only seemed to go up. It felt like the party would never end. But beneath this glittering facade, the entire system was a house of cards. The biggest illusion was the stock market itself. People weren't just investing their savings, they were gambling with borrowed money on an unprecedented scale. This was the era of buying on margin. Imagine walking into a brokerage and wanting to buy $10,000 worth of stock. You didn't need $10,000, you only needed $1,000. The broker would lend you the other $9,000. You were borrowing up to 90% of the stock's value. As long as the market went up, everyone was a genius. Your $1,000 could quickly double or triple. But if the market dipped by just 10%, your entire investment was wiped out, and you still owed the broker thousands. By 1929, the total amount of margin debt was colossal, turning the stock market into a highly leveraged, dangerously unstable bubble. And the banks? They were the ones fueling this fire. In the 1920s, there was almost no federal oversight. The Glass-Steagall Act, which separated commercial and investment banking, hadn't been invented yet. So, the same bank where your grandma deposited her life savings could take that money and speculate wildly on the stock market or make risky loans to margin investors. They were playing roulette with depositors' money, and nobody was stopping them. This created a system where the failure of one part, the stock market, would instantly threaten the entire banking sector. The firewall that exists today simply wasn't there. Meanwhile, out in the real economy, another crisis was brewing. American factories and farms were marvels of productivity. They were churning out cars, radios, and mountains of wheat like never before. There was just one problem. Who was going to buy all this stuff? While corporate profits soared and the rich got richer, wages for the average worker stagnated. The wealth gap was immense. The top 1% of Americans held over a third of the nation's wealth. The majority of families didn't have the purchasing power to absorb the flood of goods being produced. Warehouses filled up with unsold products. Farmers who had taken out loans to expand during World War I were now facing a surplus that caused crop prices to plummet. They couldn't pay their debts, and rural banks started failing long before the 1929 crash. The economy was like an engine running faster and faster, but with no fuel going in. Then there was the international picture, which was just as bleak. The aftermath of World War I left a tangled web of war debts and reparations. Germany was forced to pay crippling sums to the Allies, who in turn owed massive amounts to the United States. This created a fragile circular flow of money. American banks lent to Germany, Germany paid Britain and France paid back the U.S. It only worked as long as American money kept flowing. Compounding this problem was the gold standard. Most major currencies were pegged to a fixed amount of gold. This meant governments couldn't just print more money to stimulate their economies or devalue their currency to make exports cheaper. Their hands were tied. When the economic pressures started to build, the gold standard acted like a straitjacket, transmitting financial shocks from one country to the next, and preventing any effective response. So, by 1928, a year before the crash, all the warning signs were flashing red. Commodity prices were falling, construction was slowing down, international trade was shrinking, the credit system was stretched to its absolute limit. The stock market was the last part of the party, a dizzying spectacle completely detached from the rotting economic reality underneath. It wasn't the cause of the Great Depression. It was merely the symptom that finally burst into the open. And then, in October 1929, it happened. The market shuddered. A few big investors started selling. Then a little panic set in. The margin calls began. Brokers demanded investors pay back their loans immediately. But nobody had the cash. They were forced to sell their stocks to cover the debt, which pushed prices down further, triggering more margin calls and more forced selling. It was a death spiral. On October 29th, Black Tuesday, the market collapsed. In a matter of days, $30 billion in stock value vanished into thin air. To put that in perspective, that was more than the entire U.S. federal budget for that year. It was more than the total cost of America's involvement in World War I. But the real catastrophe was just beginning. The stock market crash was the spark that lit the fuse on the banking system. As stock prices plummeted, the banks that had gambled with depositors' money were instantly insolvent. Their assets were worthless. Fear, a force more powerful than any economic policy, took over. People heard rumors that their bank was in trouble, and they rushed to pull their money out. This is a bank run. And because banks don't keep all their deposits in a vault, they lend it out. They couldn't meet the demand. The first bank to collapse triggered panic about the bank next door, and the fear spread like a virus. Over the next few years, over 9,000 banks in the United States failed. When a bank failed, it wasn't like today where your deposits are insured. If your bank went under, your life savings disappeared. Gone. Forever. This was the true engine of the Great Depression. The collapse of the banking system destroyed savings and, more importantly, it destroyed credit. Without credit, businesses couldn't get loans to make payroll or buy materials. Farmers couldn't get loans to plant crops. The entire economy froze. Companies went bankrupt. Factories shut down. Unemployment skyrocketed from just over 3% in 1929 to a staggering 25% by 1933. 1 in every 4 workers was jobless. In industrial cities, the rate was often 50% or higher. Breadlines and soup kitchens became the symbols of a broken nation. The crisis went global. As American banks failed, they called in their international loans, causing the fragile system of debt repayment to collapse. The gold standard forced countries into a brutal competition of deflation, strangling trade. Global trade fell by 2/3. It was a domino effect on a planetary scale. So, what's the ultimate lesson here? The Great Depression wasn't a single event. It was a cascade of failures. It was a failure of regulation, allowing finance to become a reckless casino. It was a failure of income distribution, creating an economy that couldn't sustain itself. And it was a failure of international cooperation, where nations chose to save themselves at the expense of everyone else. It teaches us that confidence is the bedrock of any economy. Once it's gone, it's incredibly hard to get back. Governments at the time didn't understand this. Their response was often to do the exact wrong thing: raise tariffs, cut spending, and cling to the gold standard, all of which made the Depression deeper and longer. It wasn't until new leadership and radical new ideas, like the New Deal in the U.S., that things began to change. Programs like deposit insurance, Social Security, and financial regulation were born directly from the ashes of this disaster. They were designed to prevent this kind of collapse from ever happening again. But are we safe? Think about it. We see massive corporate and government debt. We see asset bubbles in stocks, crypto, and real estate, often fueled by low interest rates and easy credit. We see growing wealth inequality and fragile global supply chains. We see nations turning inward. The parallels aren't perfect, but they are unsettling. The story of the 1930s isn't just history. It's a blueprint for disaster, showing how quickly stability can turn to chaos when greed, fragility, and bad policy combine. Understanding it is crucial to navigating the crises of our own time. What do you think? Are we seeing echoes of the 1920s today? Are we ignoring the warning signs just like they did back then? Let me know your thoughts down in the comments. I read all of them. What if I told you the Great Depression wasn't caused by the stock market crash of 1929? That's what we're all taught in school, right? A single day of chaos on Wall Street that plunged the world into a decade of darkness. But that's a dangerously simple myth. The crash was just the trigger, the first crack in a dam that was already about to burst. The real disaster, the thing that turned a recession into a full-blown societal collapse, was a series of catastrophic decisions made by the very people who were supposed to be in charge. Let's rewind. In the aftermath of the 1929 crash, fear gripped the markets. People rushed to pull their money out of banks, and businesses couldn't get loans. This is a classic liquidity crisis. The textbook solution, what we do today, is for the central bank, in this case, the Federal Reserve, to flood the system with money. You lower interest rates, make it easy to borrow, and restore confidence. But the Fed did the exact opposite. They tightened the money supply. They raised interest rates. Why? They believed that the rampant speculation of the Roaring Twenties was a moral failure that needed to be punished. They chose to discipline the market instead of saving the economy. This wasn't just a mistake. It was like throwing an anchor to a drowning man. As credit dried up, the real economy began to seize. Factories that were perfectly capable of producing goods had to shut down. It wasn't because of a lack of demand for products, but a lack of credit. Imagine a simple transaction. A farmer wants to sell wheat to a baker, who then sells bread to a grocer. This entire chain relies on short-term loans and trust. When the banks stopped lending, that chain broke. Farmers couldn't afford to harvest their crops, and factories couldn't pay for raw materials. Suddenly, you had warehouses full of goods that couldn't be sold, and millions of people who wanted to buy them but had no money. The economy was frozen solid. But the blunders didn't stop there. As the crisis deepened, politicians looked for someone to blame. Their target? Foreign competition. In 1930, the United States passed the Hawley-Smoot Tariff Act, one of the most destructive pieces of legislation in history. It raised import taxes on over 20,000 foreign goods to record highs. The idea was to protect American jobs by making foreign products too expensive, but it backfired spectacularly. Other countries weren't just going to sit back and take it. They retaliated with their own tariffs on American goods. Global trade, the lifeblood of the world economy, ground to a virtual halt. American exports plummeted by over 60%. The very farmers and factory workers the tariff was supposed to protect were now cut off from their international markets. It created a global death spiral where every country tried to save itself by walling itself off, but in doing so, they collectively destroyed the entire system. Protectionism didn't protect anyone. It just spread the economic disease worldwide. And then there was the financial straitjacket known as the gold standard. At the time, most major currencies were pegged to a fixed amount of gold. This meant a country couldn't just print more money to stimulate its economy because its currency had to be backed by physical gold reserves. As the Depression worsened and people panicked, they started hoarding gold, pulling it out of the banking system. This forced governments to defend their gold reserves by, you guessed it, raising interest rates even further, which just made the economic contraction worse. The gold standard prevented nations from using the one tool that might have helped: monetary policy. It was a rigid system in a world that desperately needed flexibility. By the time the government finally grasped the scale of the disaster, it was too late. Millions were unemployed, forming breadlines that stretched for blocks. In the agricultural heartland, crop prices had fallen by 60%, and farmers who couldn't sell their produce were forced to let it rot in the fields while people in the cities starved. Entire neighborhoods became shanty towns nicknamed Hoovervilles in a bitter jab at the president. The fabric of society was tearing apart, so how did the world finally escape this nightmare? It took a complete reversal of every single failed policy. Franklin D. Roosevelt's New Deal was the start. The United States finally abandoned the gold standard, which immediately allowed the government to devalue the dollar and print money to fight deflation. They launched massive public works programs like the Hoover Dam and the Tennessee Valley Authority, creating millions of jobs and pumping money directly into the economy. Crucially, they regulated the banks with the Glass-Steagall Act, separating commercial and investment banking to prevent the kind of reckless speculation that led to the crash. It was a complete rewriting of the rules of finance. But the most important lesson from the Great Depression isn't about tariffs or gold. It's about something far more fundamental: confidence. An economy isn't just numbers on a spreadsheet, it's a web of human trust. Trust in banks to keep your money safe, trust in markets to be fair, trust in the future. When that trust evaporates, the system collapses, no matter how many factories you have or how much stuff you can produce. Once confidence is gone, everything else follows. Now here's the uncomfortable truth. The Great Depression wasn't some ancient black and white historical event. It was the prototype for modern financial fragility. The blueprint is always the same. First, a period of easy credit leads to a massive buildup of leverage and debt. Then, speculation takes over, whether it's in stocks, real estate, or complex derivatives. The debt becomes unsustainable. Eventually, one pillar falls, and the shockwave threatens to bring the whole structure down. Think about the 2008 financial crisis. It followed the same pattern. Cheap money fueled a housing bubble. Wall Street bundled up risky mortgages into complex securities they themselves didn't understand. And when the housing market cracked, the global financial system nearly imploded. And what about 2020? The pandemic triggered a crisis, but it was the underlying fragility of just-in-time supply chains and corporate debt that magnified the economic shock. We are now heading into what many analysts are calling a major debt reset cycle around 2026, with sovereign debt levels at historic highs. The same pressures are building. The Great Depression taught us that economic disasters don't just happen overnight. They are the result of years of pressure, denial, and ignored warning signs. The crash of 1929 was just the symptom. The disease was a system built on unsustainable debt and flawed ideology. If you truly understand the mechanics of what happened back then, the sequence of policy errors, the psychology of fear, and the domino effect of interconnected systems, you can start to see the echoes of those patterns playing out right now. You can spot the next breakdown long before it makes headlines. History doesn't repeat itself, but it certainly rhymes. The details change, but the fundamental dynamics of debt, greed, and fear are timeless. What happened in the 1930s is more relevant today than ever before. It's a roadmap of what to watch for, and more importantly, what to avoid. If you want to understand how the past is shaping our future, stick with this channel. In our next episodes, we're going to connect the dots between 1929 and the dangerous patterns that are repeating right now in our own economy. Thanks for watching, and be sure to subscribe so you don't miss what's coming next.